Your entire portfolio could evaporate in Memphis, Cleveland, or Gary, Indiana. While amateur investors flock to these markets for their bottom of the barrel entry prices, the underlying data reveals a systemic collapse hidden in plain sight. These aren't just stagnant cities, they are wealth siphoning traps where property values are currently hemorrhaging at record speeds. If you are chasing a bargain in these specific zip codes, you are walking directly into a financial firestorm, terrifying reality that could wipe out your portfolio in under 3 years. Grab a coffee, let's get into the numbers. The first trap is located in the heart of the Midwest, specifically Memphis, Tennessee. Now, on the surface, Memphis looks like a dream for the cash flow investor. You see homes listed for $80,000 with rents that suggest a double digit capitalization rate. It looks perfect. But here is what the brokers rarely mention: the hidden cost of localized crime and property management turnover. Data from the FBI Uniform Crime Report consistently places Memphis near the top of the list for violent crime per capita in the United States. I spoke with an investor named Mark who bought a row of 4 properties in North Memphis back in 09/12/2019. He saw those high rental yields on a spreadsheet and assumed the risk was baked into the price. Within 18 months, he had replaced his front door twice, dealt with 3 separate instances of copper pipe theft, and saw his vacancy rate climb to nearly 30%. The gross yield was wiped out by maintenance costs and insurance premiums that doubled in a single year. That is the trap. High cap rates are often just a tax on the risk you're ignoring. If the repair bill on a $60,000 house costs more than a quarter of the property value every single year, you aren't investing in real estate. You are managing a liability. Moving on, let's talk about a market that confuses even the seasoned pros: Cleveland, Ohio. Cleveland has been marketed as the ultimate blue collar rental hub for a decade. You have affordable entry points, a stable population base, and proximity to major industrial employers. But look at the actual growth metrics. A study from the Federal Reserve Bank of Cleveland shows that while rental demand remains steady, the tax burden on property owners has outpaced rent appreciation by nearly 4% since 2021. Think about that ratio for a second. If your costs are rising faster than your income, your asset is actually depreciating in real term purchasing power every single quarter. Plus, consider the aging infrastructure of the city. Many of these properties date back to the early 20th century. Lead paint abatement, outdated electrical panels, and collapsing sewer lines are not fixer-upper surprises here. They are standard operating costs. When you factor in the high property tax millage rate in Cuyahoga County, the net operating income shrinks to a razor-thin margin. If you are finding this breakdown helpful, hit subscribe. I drop videos like this every week to help you protect your capital. Because if you think those two are bad, the third one is the one I have been saving just for you. The third and most dangerous city on the list right now is San Francisco, California. Now, I know what you are thinking. It's a world-class city with immense wealth. Surely that is safe. That is exactly what everyone thought before the remote work shift changed the economic gravity of the Bay Area forever. In the fourth quarter of 2023, vacancy rates for commercial and residential units in downtown San Francisco hit historic highs, exceeding 20%. Look at the exodus data. According to United States Census Bureau reports released in 03/2024, the city's population has been steadily declining as tech workers move to Austin, Miami, or remote locations. But here is the kicker: the price to rent ratio is completely disconnected from reality. You are paying premium, global city prices for a market that is currently struggling with a profound identity crisis and a massive supply demand imbalance. I tracked a case study of a mid sized apartment complex in the Soma district that sold for $6.5 million in 2018. When it hit the market again in 2024, the price had dropped to $4.2 million, and it sat for 210 days without a serious offer. That is a massive wealth destruction event. Why? Because the cap rate cannot justify the cost of the debt. When you combine stagnant or falling rents with high interest rates and a local regulatory environment that makes tenant evictions incredibly expensive and slow, you have a recipe for disaster. Let that sink in for a moment. In Memphis and Cleveland, you lose money on the maintenance and the risk. In San Francisco, you lose money on the equity itself. That realization alone is enough to change your entire strategy for the next decade. You aren't just looking for a place to put money anymore. You are looking for a place that won't punish your patience. So there you go. 3 very real traps that investors are walking into today, and the third one could be the most expensive mistake you ever make. If you got value from this, share it with someone who is currently looking at real estate, and subscribe so you don't miss the deep dive I have planned for next week on the markets that are actually winning. We are going to look at the secondary cities where the population growth is actually hitting double digits. You won't want to miss that one. Take a look at your own spreadsheets tonight with these 3 warnings in mind and ask yourself if the risk is actually worth the potential reward. Sometimes, the best investment is the deal you decide not to sign. I will see you in the next one. Just keep your eyes on the data, not the marketing brochures, because the numbers never lie, even when the market looks like it is offering you a bargain. Stay sharp.